You know, when you try to picture the headquarters of a massive global conglomerate, I mean, the kind of entity that owns railroads and insurance giants and energy companies, you usually imagine this, like high-tech war room.
Oh, absolutely. Like screens covering every wall, right?
Yeah, exactly. Screens everywhere, thousands of analysts aggressively crunching numbers, thick binders of corporate policies just stacked to the ceiling. It feels like the command center of a small nation state.
Right. And it's built entirely on layers of control, endless bureaucracy to keep the whole massive thing from just spinning apart.
And that command and control structure, we just accept it. We accept it as an absolute necessity for modern business. Like, when an organization scales to hundreds of thousands of employees, you simply must have those rigid layers of oversight.
It's the standard playbook. Everyone does it.
But what if, and this is wild, what if the command center for one of the most successful holding companies in the history of capitalism is literally just a handful of people in a rented office?
Operating almost entirely on trust and a handshake.
It's crazy. So, welcome to this deep dive. I'm your host, and today we are immersing ourselves in the foundational business principles of Warren Buffett. We're drawing directly from the Essays of Warren Buffett, Lessons for Corporate America, specifically zeroing in on Part 1, which covers governance and management.
And I'm your resident expert, and I just have to say, this text is remarkable because, it strips away all that impenetrable Wall Street jargon and really forces you to look at the raw mechanics of corporate governance. This is not just some dry, high finance manual.
No, not at all. It fundamentally alters how you view leadership. So whether you are prepping for a boardroom meeting, maybe evaluating the executive team at your own company, or, you're just trying to be a smarter investor with your own savings, this deep dive is going to give you a blueprint for how a healthy corporate system actually should operate, just by focusing on basic human incentives.
Exactly. Human incentives drive everything.
Okay, let's unpack this. How do you manage a massive public corporation as if it were a local, intimate partnership?
Well, to understand the mechanics of that, we really have to look at how deeply contrarian Buffett's philosophy is. Because modern corporate America runs on this very specific frantic engine. It's an obsession with short-term stock prices, quarterly earnings guidance, and this phenomenon Buffett calls the institutional imperative.
Oh, the institutional imperative is fascinating. It's essentially the psychological tendency for corporate leaders to just blindly copy whatever their peers are doing, even if it's, a fundamentally terrible idea.
Right. Like if your competitor buys a failing company, you suddenly feel the need to buy a failing company just to keep up appearances.
It's literally corporate peer pressure.
That's exactly what it is. And the primary way the source material shows Buffett fighting this peer pressure is through how he frames the actual owners of their shareholders. He completely refuses to see them as faceless data points moving on a ticker tape.
Right.
He views them as literal business partners. And I mean, that isn't just lip service. He has ultimate skin in the game. Over 99% of his own personal wealth is tied up in Berkshire stock.
Which brings a totally different level of gravity to the table. And to understand who he wants sitting at that table with him, the text outlines this concept of the 5 buckets of shareholders.
Yeah, this is a great breakdown.
So if you follow the markets, you know these players. Bucket 1 is Buffett himself, the owner-manager. Bucket 2 is index funds, which, as we know, they just buy mechanically because their algorithms dictate they have to track a specific index.
Right, they're on autopilot.
Exactly. Then Bucket 3 represents active institutional managers. These are the professionals constantly trading in and out of positions based on macroeconomic trends or quarterly whispers. Then Bucket 4 consists of active individual investors, basically doing the exact same rapid-fire trading, but on a smaller retail scale.
And we see those first 4 buckets dominate the financial news cycle every single day, right? They create all the volatility, all the noise. But Buffett focuses entirely on the 5th bucket.
The 5th bucket.
Yeah, the 5th bucket consists of long-term individual investors. I mean, these are people who buy the stock with the intention of basically never selling it.
Right.
They treat the purchase of a public stock exactly the same way they would treat buying a physical farm or like a local car dealership.
The source material shares an incredible anecdote to illustrate this. It focuses on a man named Dr. Stan Trulson. He was an eye doctor in Omaha. Back in 1959, long before the massive conglomerate we know today existed, he and 10 other young doctors formed an investment partnership with Buffett.
They called it MD Limited, right?
Yeah, MD, as in the medical degree. Very clever.
Ugh.
So years later, that partnership converted into Berkshire stock, and they just held it. They didn't trade the swings. They didn't panic during recessions. They literally held it into their 90s and in some cases past 100 years old.
Oh, wow.
It's a literal till death do us part mentality.
Which is so rare. And Buffett actually relies on a brilliant analogy from the legendary investor Phil Fisher to explain why cultivating that specific type of shareholder is so critical. Fisher argued that a business is very much like a restaurant.
Okay, I like this.
You can choose to serve exquisite, high-end French cuisine, or you can serve burgers and Coke. Both can be highly successful, profitable business models. But the one thing you cannot do is constantly change the menu and expect to keep a loyal customer base.
Right. If you build a loyal crowd of people who come in every Friday expecting a great burger, and suddenly you hand them escargot, they're going to walk out the door and never come back.
Exactly. And Berkshire serves burgers and Coke. They have maintained a completely consistent, predictable business model for decades just to keep those fifth bucket investors anchored.
It's so different from the rest of the market. I mean, modern Wall Street day trading treats companies like a series of one-night stands. You get in, you ride the momentum, you take your cut, and you leave. But Buffett, he's looking for a marriage.
And that desire for a corporate marriage, it completely upends standard CEO behavior.
Okay, let me play devil's advocate here, though. Because the standard corporate practice, the thing every CEO is essentially hired to do, is to push the stock price as high as humanly possible to appease all investors.
Sure.
Why wouldn't you want a soaring stock price regardless of who is buying it? If the market wants to overvalue your company, shouldn't you just take the win?
Well, what's fascinating here is why Buffett explicitly rejects that. He states very clearly that he does not want the stock price to be artificially high. He wants the price to perfectly match the company's intrinsic value. He wants it tracking the actual business performance as closely as possible.
Wait, because if the stock price drastically outpaces the fundamental value of the business, it naturally attracts the bucket 3 and bucket 4 investors.
Right, the short-term speculators looking for momentum.
Ah, I see.
Precisely. And more deeply, when a stock is massively overpriced, true wealth isn't actually being created by the business operations. It's simply being transferred from the new buyer to the seller. It just becomes a zero-sum game.
Yeah, that makes sense.
Buffett wants the wealth created by the company's operational success to go directly to the people who hold the stock through the decades, not the ones actively trading the volatility. He wants a fair game for the regulars sitting in his restaurant.
You want the value to reflect reality, not just hype. But, if your goal is to protect those restaurant regulars, you run into a massive logistical problem. A fifth bucket investor, let's say our retired eye doctor in Omaha, he can't walk into a corporate boardroom in New York City every Tuesday to make sure the CEO isn't wasting his money on, corporate jets or bad acquisitions.
Yeah, of course not.
They need a proxy. They need an overseer. And that brings us to the watchdogs of corporate America, the board of directors.
Which, in theory, the primary job of a board of directors is incredibly straightforward, right? Find a great CEO, ensure they're running the business in the long-term interests of the shareholders, and step in immediately if that CEO gets off track.
In theory.
In theory. But the source material just tears into the reality of modern corporate governance, exposing it as deeply compromised.
Compromised might be letting them off easy. The text heavily critiques the myth of the modern independent director. It highlights how director fees have absolutely skyrocketed. We are talking about compensation in the range of $250,000 to $300,000 a year for what often amounts to attending a handful of meetings and reading a few reports.
It's wild.
Think about that from the perspective of the average person listening right now. That is 3 to 4 times the median U.S. household income just handed out for a part-time side gig.
Right, and we have to look at how that financial reality fundamentally alters human psychology in the boardroom. I mean, when someone is handed an absolute goldmine of a position, their primary human instinct is self-preservation. They desperately want to keep that seat.
Oh, totally.
Furthermore, they want the CEO to recommend them for other corporate boards so they can double or triple that income.
Which means instead of acting as the necessary bulldogs who ask uncomfortable questions and challenge the CEO's wild expansion plans, they transform into compliant cocker spaniels.
Yes, the cocker spaniels.
They nod, they agree, and they approve the budget because nobody invites a snarling bulldog to the country club.
Exactly. And the text offers a chilling anecdote about this exact dynamic playing out in real time. There was a company that received a highly lucrative buyout offer. The price was fantastic. It would have delivered massive value to the shareholders, effectively making them very rich.
So an obvious yes.
But the board killed the deal. They completely rejected it. And the underlying reason was simply that the directors realized if the company was sold, they would lose their $100,000 a year stipends.
Wow. Just to protect their own paychecks.
Yeah. The source material actually uses a biblical quote to summarize this behavior. For where your treasure is, there your heart will be also.
Their stipends were their treasure, not the shareholder value they were sworn to protect. But let me push back on this concept of the board again, because the whole governance trend over the last 20 years has been to demand independent directors, meaning regulators want board members who do not have prior financial ties, family connections, or insider relationships with the company.
Right.
The logic is that lacking those ties objectively prevents bias. Isn't that a good thing?
Well, it sounds incredibly logical on paper, but Buffett argues it completely misses the actual mechanism of human motivation. He actually prefers directors who have a massive chunk of their own personal wealth tied up in the company's stock.
Right, really?
Yes. And crucially, this must be stock they purchased in the open market with their own hard-earned money, not stock options that were just gifted to them by the corporation.
So true independence isn't about lacking financial ties at all. It's about ensuring your financial ties align perfectly with the people you are supposed to represent.
Exactly.
If a director's personal net worth plummets every time they approve a foolish acquisition, they're going to stop acting like a Cocker Spaniel and start acting like a bulldog immediately.
Because they finally have real skin in the game. And without that skin in the game, when you have a room full of Cocker Spaniels setting the policies, you end up with one of the most destructive forces in modern business, atrocious executive compensation packages.
Okay. Here's where it gets really interesting, and frankly, a bit infuriating if you hold stock in standard public companies. Let's break down the mechanics of how executives get paid. So, the standard corporate practice is to award management with 10-year fixed-price stock options. The fundamental flaw here is that these options reward executives simply for retaining earnings, rather than generating true, exceptional business success. The text uses this brilliant mathematical example called the Rip Van Winkle scenario.
Yes, let's walk through the math of how this scenario actually plays out over a decade.
So imagine a CEO of a completely stagnant, zero-growth company. They literally fall asleep at their desk for 10 years, like Rip Van Winkle.
Just completely checked out.
Exactly. And during that decade, they pay zero dividends to the shareholders. Instead, they just take all the natural cash the business generates and use it to buy back their own stock on the open market. Because they are constantly shrinking the supply of shares, the earnings per share mathematically have to go up, which pushes the stock price up.
It's pure financial gravity.
Right?
It has nothing to do with skill.
Exactly. When our sleeping CEO finally wakes up 10 years later, their fixed price options vest, and they personally walk away with $158 million. And here is the absolute kicker. They capture that massive wealth even if the company's actual underlying profitability dropped by 20% over that decade.
It's mind-boggling. They're capturing wealth simply by letting the company's capital sit there and automatically compound.
Yeah.
They haven't applied any unique managerial genius. They haven't innovated. They haven't grown the market share.
Imagine you have a savings account, right?
Yeah.
You hire a bank manager, and you let your money sit there collecting 8% compound interest for a decade.
Okay.
Then the bank manager demands a multi-million-dollar personal bonus just because the account balance went up. You would be outraged.
You fire them on the spot.
Right, because they didn't do anything. They just watched the math happen. Yet this is standard corporate practice.
And this creates that bitter reality of modern corporate pay that Buffett highlights. Nothing succeeds like failure. I mean, we constantly see executives mismanage companies, get fired, and still walk away with these massive golden parachutes. They make more money in a single afternoon of being fired than an average laborer will make in a lifetime of hard work.
It's so broken. So if standard boards are broken and fixed price options are essentially a rigged game, how does the Berkshire system actually structure compensation? Because they obviously employ highly paid top-tier executives to run their subsidiaries.
Well, the structure is entirely different, and it completely removes the macro market from the equation. First off, There are absolutely no stock options. None.
Wow.
Instead, they use cash bonuses. Secondly, those bonuses are tied directly to the performance of that executive's specific business unit.
So it's granular.
Very granular. If you run the shoe company, your bonus is dictated by the operating profit of the shoe company. It does not matter if the overall parent company's stock goes up or down in the market. You are paid for what you actually control. And finally, there are no upward limits on these bonuses. If you perform exceptionally, you are compensated exceptionally.
But there is a crucial mechanism here that prevents executives from just recklessly expanding their divisions to boost those numbers, right? Like a hurdle they have to clear.
Yes, and this is perhaps the most important concept in capital allocation. This is where we get into the why behind capital cost. Because in standard companies, executives often treat money from headquarters as if it's free. If they want to build a new factory just to make their division look bigger, they just ask the board for the cash.
Right, it's play money to them.
But in the Berkshire model, capital is never free. Let's say a subsidiary manager wants $10 million to build a new distribution center. Headquarters will grant that request, but they essentially say, fine, but we are going to charge you a steep cost of capital, let's call it 15%, on your performance review.
Okay, so what does that mean in practice?
It means that manager knows, before they even break ground, that if their new distribution center doesn't generate at least $1.5 million in new bottom line profit every single year just to cover that internal hurdle rate, the shortfall will be deducted from their personal bonus.
Oh, wow. Okay, so suddenly that manager isn't building a distribution center just to inflate their ego or build a corporate empire. They only take the capital if they are absolutely mathematically certain it will generate a high return. It enforces extreme discipline.
Exactly. It perfectly aligns the executive's personal financial risk with the shareholder's financial risk.
Okay, so if we zoom out for a second. We've established that the standard board of directors is psychologically compromised, and standard executive compensation is mathematically flawed. If you reject those standard levers of control, what actually holds a massive conglomerate together? I mean, how do you prevent a company with roughly 360,000 employees from collapsing into total chaos without a centralized command center?
You have to build an anti-fragile culture.
And that culture is highly visible the moment you look at how the parent company operates. I mean, the physical and structural footprint of Berkshire headquarters is genuinely shocking for a company valued in the hundreds of billions.
Oh, it completely defies logic.
Yeah.
There is no massive corporate bureaucracy. There is no central human resources department, no centralized legal department drafting endless policies, no PR team spinning narratives.
It's so lean.
The text cites the annual rent for their world headquarters as just $270,212. To put that in perspective, there are mid-level executives in standard companies whose travel budgets are higher than the rent for this entire conglomerate's command center.
That is insane.
But if we connect this to the bigger picture, keeping headquarters small isn't some gimmick to save a few dollars on rent. It is the physical manifestation of an extreme, radical level of trust. The business model relies on acquiring companies that already possess proven, deeply passionate management teams. In fact, the text notes a fascinating statistic. Roughly 75% of the managers who run these subsidiaries were already independently wealthy when Berkshire acquired their companies.
Which changes everything. I mean, if you have $100 million in the bank, you don't have to go to work on a Tuesday.
Precisely. They are working purely for the love of the game. They love their specific business. So when you acquire an enterprise run by an already successful, wealthy founder who views their company as their life's masterpiece, the absolute worst thing you can do is impose a central HR department to breathe down their neck and tell them how to fill out expense reports.
You just eliminate the micromanagement, you let them play their game, and the mandate given to these CEOs is beautifully simple, yet profoundly difficult. Headquarters tells them to manage their business as if it is the only asset their family will own for the next 100 years, and they are strictly forbidden from ever selling it.
Think about the psychological shift that mandate creates. If you can never sell the business, and it must support your family for a century, you stop managing for the next quarterly earnings call. You stop caring about Wall Street's short-term expectations. It naturally vaccinates the entire organization against that institutional imperative we discussed earlier. You won't make a reckless acquisition just because a competitor did, because you have to live with the consequences of that acquisition for 100 years.
They also utilize a fascinating cultural guardrail for hiring, borrowed from the advertising legend David Ogilvy. The Ogilvy rule states, If we hire people smaller than us, we become a company of dwarfs. But if we hire people bigger than us, we become a company of giants. It forces leaders to check their egos at the door and actively seek out subordinates who are smarter, faster, and more capable than they are without feeling threatened by them.
Which is really the only effective way to fight what the source material identifies as the three key corporate tumors that must be eradicated at all costs: arrogance, bureaucracy, and complacency.
Arrogance, bureaucracy, complacency, the silent killers of empires, because arrogance blinds you to innovation, bureaucracy suffocates your talented people with paperwork, and complacency just lets your competitors steal your regulars.
Exactly. The underlying thesis of the entire text is that businesses rarely die because of a sudden, brilliant move by a competitor. They die from within. They die from those three tumors.
So as we wrap up this deep dive, what is the ultimate takeaway for you listening right now? Whether you are allocating your retirement savings, evaluating the stock of a company, or just managing a small team in your own career, you have to apply this owner's mindset. Look deeply at the incentives. Does the person managing the money actually suffer personal financial pain if they lose it? Avoid the institutional imperative, stop doing things simply because your peers or competitors are doing them, and demand utter transparency over bureaucratic jargon. If a company requires a 50-page PowerPoint to explain the math behind how the CEO gets their bonus, it is almost certainly a system designed to hide a rigged game.
It always comes back to human nature. A corporation isn't a machine, it's just a collection of human beings. If the structural incentives encourage selfish short-term behavior, you will get selfish short-term behavior, regardless of how prestigious the brand name on the building might be.
Absolutely. But I want to leave you with a final provocative thought to chew on as you go about your day. The source material strongly argues that Berkshire's decentralized, extreme trust-based culture is hardwired to survive long after its current legendary leadership is gone. But consider the reality of human behavior. Can a corporate system built almost entirely on the moral authority, the unparalleled personal trust, and the unique hands-off charisma of one individual truly survive without them at the helm?
It really is the ultimate stress test of the entire philosophy.
When the architect of that century-long culture is finally gone, does human nature inevitably force bureaucracy to creep back in to fill the void? Does that small rented office in Omaha suddenly start looking a lot more like the Death Star command center because the new generation of leaders don't have that same gravitational pull to keep the subsidiaries in orbit? It's something to seriously mull over as you evaluate the institutions you invest your own time, energy, and money into. We started by picturing the standard corporate war room and realized the most powerful alternative ever built runs on a handshake, aligned incentives, and a long-term menu. The real question is, how long can that handshake hold? Thanks for joining us on this deep dive. Keep questioning the consensus, and we'll see you next time.